This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
We now look at some quantitative aspects of risk analysis. How much would the loss be, and what is its probability of occurrence? Risk quantification, it could be the average loss or the expected loss. We can look at the frequency of losses. We can look at the largest predictable loss. We can look at what's called the dispersion of the risk. Is it very finely dispersed so that there's very little chance of going outside a particular set of results, or is it a very wide possibilities? When it comes to looking at assets, physical assets, we can look at the risk in terms of its total loss, or perhaps its repair, perhaps its replacement, or its decrease in value. All of these are potential measures of the risk that we are experiencing. In financial assets, we can look at, basically it's going to be the loss in value. If you have money in shares, what's the minimum value it's likely to end up at, say, over a period of a month. There are certain sorts of financial transaction where the risks are actually unlimited. Think of insurance. You take a relatively small premium, and if a disaster happens to one of your clients, then of course the loss could be thousands of times what the premium actually was. And there's also a risk to your human assets. Death or injury, key personnel can leave, they can defect to competitors and so on, and there can be real problems, maybe not only with the knowledge that they're taking with them, but the more basic problems of just continuing the business without these people. This is maybe a relatively long chapter with a number of mathematical techniques. I'll cover them relatively briefly. They are covered in more detail in the notes. So this is just trying to kind of orientate you. So the first approach which we can take is to look at something called expected values. So here what we have in the table which has been set out, we've got two states of the world, and that the state of the world is this very general name for it could be economy 1, economy 2, it could be government 1, it could be government 2, it could be the chance of war, the chance of not war, and so on, just two states of the world. And we've managed to put two probabilities of these, 0.6 and 0.4. I'll repeat it later, but I'll say it now, that this must be one of the most difficult aspects to actually forecast. What's the probability that a certain government will get in, and even with lots of polls and opinion polls and forecasts and so on, they often get it quite wrong. What's the chance of an economy improving or getting worse? And we've all sorts of analysts with a great range of opinion there. So getting these probabilities with any degree of certainty almost, or reliability, must be quite difficult. And this example deals with two projects, or two factories, or perhaps opening in country B. A project is a very general name. And if we invest in project A, and they're going to be identical costs of these projects, then we could get 2,000 or 10,000 with a probability of 0.6 or 0.4. However, in project B, we're going to get 4,000 or 6,500. Again, with the probabilities of 0.6 and 0.4. And what the expected value technique does, it multiplies the probability by each of the outcomes. So 0.6 times 2,000 is going to be 1,200. There's a 0.4 chance of earning 10,000, so that it comes out at 4,000. So you add these together, the sum of the probabilities times the outcomes gives you your expected value. On project B, it's going to be 0.6 times 0.4 gives you 2,400, or 0.4 times 6,500 is going to give you 2,600. Now the conventional treatment of these expected values is you go for the one which is higher. So here people will be looking at this and say, right, the best chance, if you like, or the best combination of chance and outcomes is 5,200. We'll go for that, and that beats 5,000. The problem with this technique is it's really not very applicable if it is a once-off project. If this was something which is repeated every week, you know, sales in week 1, sales in week 2, sales in week 1, week type 1, sales in week type 2, then the long-term averages would end up being this. But if it's a once-off project, you have a once and only chance of building factory A, factory B, opening in country A, country B, then it's got big problems with it. First of all, let's say that the cost that we've got in here, the cost of the project is going to be 3,800. Now if you look at project A, cost of 3,800, there is a 0.6 chance, a better than evens chance, you're going to only make 2,000, you're making a loss there of 1,800. Which could be absolutely catastrophic for the company. If however you look at project B and the cost is 3,800, we are never envisaging, even in our worst kind of scenario, of ever actually making a loss. So one of the things that this expected value obscures really is the risk. Yes, the expected value is 5,200, but that hides really the potential, a very high potential really, of making a loss in there of 1,800. Whereas the slightly lower expected value, there is no possibility, as far as we know, of making a loss. So expected values is actually quite bad on risk analysis. It obscures this, it kind of runs it all into one figure. Second problem really is that the expected value is not actually expected. Nowhere in our wildest dreams do we actually envisage that project A will give us 5,200. It's either going to be 2,000 or 10,000. Similarly, that should be saying B here. Similarly, project B, we don't ever envisage 5,000 coming out. It's either going to be 4,000 or 6,500. So here we're making kind of decision based on figures which we know, or as far as we know, are never going to actually occur. So there are three problems here. First of all, how do we actually assess the probabilities? Secondly, there's obscuring of the risk, particularly maybe the downside risk. And third, there is this whole almost philosophical problem of basing a decision on figures that we never actually expect to get. So it's widely used, this expected value, but as I say, the problems are assessing the probabilities. The expected value is actually often unexpected and does not actually reflect properly the range of risks or the range of outcomes to capture the risk. If we're going to be capturing the risk, we have to take into account in some way the spread, you know, the good, the bad, how likely are they, how far apart are they, how kind of dangerous are they, and so on. And this is where something called the standard deviation can come in suitable circumstances. So let's look at this here, and this is a subject now getting on we're calling value at risk. And think of it as looking at an investment in, let's say, a share, and we're looking how from day to day the value of that share kind of goes up slightly, down slightly, etc. Some days it'll go up a lot, some days it'll go down a lot. Every share will kind of jiggle up and down, if you like, in really time, if you like, with economic expectations. Now, if you have a share which is pretty stable, doesn't go up and down very much at all, this would be this kind of inner one here, a very kind of pointed, very kind of narrow. This is where you have a small standard deviation, and the standard symbol for a standard deviation is the Greek letter sigma. If, however, you have a share which bounces all over the place, a very kind of nervous, volatile share, then it would have a very large standard deviation. So the standard deviation tells us something about the spread of the possible values of the spread of the possible results. So how is this used in some sorts of financial analysis? And this is where we get on to looking at value at risk. But before we begin looking at shares, we'll take a couple of other, kind of slightly simpler examples maybe, which will teach us how to use what's called normal curves. So these shapes here, this sometimes called a bell-shaped curve like this. We're assuming here that we're dealing with what's called normal distributions. They're all the same basic shape, but just kind of wider or narrower. Okay. And many natural phenomena like height, weight, and so on follow normal distributions, and we have to assume a lot of financial measures follow this as well. So let's take a kind of physical one. Let's take one with height in here. We've done a survey of the population, and we find that the population has a mean height, let's say of 178 centimeters. So that's the mean, half above, half below. I will say that the standard deviation, the sigma in here, is equal to 3. Now what this allows us to do with tables is to work out, for example, how many people are between 178 and let's say anything you like, but let's take 180. So what proportion of the population is in that height range? Now the whole population there's 1. It's 100% or probability of 1, the whole population. That's the whole area under the curve represents everyone. Okay, and we kind of want the fraction of 1 that these people here, 178 to 180. Now this is where you need to look at what's called normal curve tables or normal distribution tables, and these are obviously provided in the exam. So here are normal distribution tables. And we've got here, they tell you in a way, if you look at them, what they're actually calculating here. We've got a Z here, and we have a Z here. And the Z here, it says, it's hard to read, but it says X minus mu over sigma. Now we're going to go back to this here. We knew the sigma was the standard deviation. This mean here is mu, Greek letter M or mu here. And the Z value, so this 180 is going to be our X here. It's a distance above the mean, which will be X minus mu. In our case, it's 180 minus 178 is the 2 extra centimeters as a number of standard deviations. And that's what's called the Z value. Terribly important. But the tables tell you that. It says at the top of the tables, Z equals X minus mu over sigma. It's a distance above or indeed below the mean is a number of standard deviations. So we work this out for this example here. We're looking at the X of 180. The mu is 178. So that's our, if you like, our 2 centimeters. And it's kind of in terms of the spread here, the standard deviation divided by 3, it's 0.667 or 0.67. So then what we do is you go to the normal curve tables and you look for a Z at presumably 0.67, it's the nearest we can get. So you go down here till you get to the 0.6 And then the next one you go along here until you get to the 0.07, so it's in here. So we line these up here, 0.6 and 0.07, 0.2486. And this 0.2486 is the proportion of the whole population, which here is between 178 and 180 centimeters. So we go from the tables where Z equals 1.67, the area or the table figure, I've forgotten what it is, I think it was 24.67, 24.86. Or 24.86%, approximately 25%. So about 25% of the population is between 178 and 180 centimeters. Now, we can turn this round a little bit. So let me get rid of some of this stuff in here. And what we'll do now, we'll keep the same basic figures going on in here. But instead of working out the proportion of people in a particular height range, we'll say how far up or down would you need to go, maybe to divide the population into kind of 95%, 5%. So, here we have our people, 178. That's our mu. Standard deviation, 3 centimeters as before. And this should be all symmetrical. I haven't drawn it very well in here. The whole thing is completely, that's better, symmetrical. And let's say we're interested in the people who are the bottom 5%. So what we want to find out really here is below what height are the shortest 5% of people. Okay. So we want to know what this x is. How far down do you have to go before you just got the 5% of people in here. Okay. So what we have to do is kind of divide it up. So we've got 50% of people up here, because half is higher, half is lower than the mean. And we must have 45% of people in there. And we must have 0.05 in there. So 0.05 is 5%. Okay. We know that the Z value is going to be mu minus x over the standard deviation. The unknown in this one is x. We know mu is the mean, 178. We want to find out what the x is, what this cutoff point that splits 95% of people to the shortest 5% in here. And we know the sigma is going to be 3. So what we need to do is find the Z value. So this is where you go to the tables, and instead of going to the Z value here, that's what we're trying to find. You go to what I call the body of the tables in here, and you want to find basically this kind of a distance here that's below. You want to find the area of 0.45. So let's go to the tables. We want it split up so this area is 0.45. If you look at the tables, it's the area from the mean up, which it tells you, all from the mean down. So basically we want 0.45. So you look in what I call the body of the tables, and look in here. So there's 0.4495. And there is 0.4505, and we're more or less bang on in between these here. And if you look back here, it's 1.64, 1.65, 1.645. So the Z value for, if you like, the 5% cutoff is 1.645. So by the time we have gone down this distribution to 1.645 sigmas, because the z value is always the distance above or below the mean as a number of standard deviations, so it's 1.645 standard deviations below the mean, then we've got this 95-5% split. So you put this in here, 1.645 is going to be 178 minus x over 3. So we turn all of this around here, and we're going to have 3 times 1.645 in that. We can go 178 minus that, really is going to be this x. So we have 178 minus 3 times 1.645, it's 173. So really, by the time you go down in here 5 centimeters, only 5% of the population is going to be less tall than 173 centimeters. What we've got in here is 173. Because the distance below the mean of 173, be 178 minus 173, that's 5, divided by 3. So you take your 5 divided by your 3, 1.66 or thereabouts. We are pretty, I mean, I've rounded a little bit, obviously. We effectively got the 5%, 95% cutoff. So that's for height. How does it work really in share values and so on? What is this value at risk? Well, it's almost exactly the same. Let's say what you had was either a single share or portfolio shares, doesn't really matter. And let's say that its mean value was equal to, let's say, 80,000. Let's say that the standard deviation, the sigma, was $5,000. The value at risk is normally measured here to this kind of 5% type of split, really. So what we're saying is, if we could lose money, could go 80,000, 75,000, 70,000, and so on here, and after some days, if you like, you're going to have a really bad day. It'll be lower than a certain amount, but we're interested in knowing this amount here. Yeah, it will be lower than a certain amount, but on only 5% of all days. So we do the same thing. So the z value is the number of standard deviations above or below the mean. So it's going to be, the mean is 80,000, and we're going down to some value x here, and the standard deviation is 5,000. If with the z value for the 5% level, I could call it level, I'll tighten this up a little bit again, is as before 1.645. So that, if you have that number of standard deviations out here, you have to kind of go beyond that, or at least to that, before you're in the lowest 5% of the values there. So it's 1.645 in terms of standard deviation. We know the standard deviation is 5,000. So So 1.645 times 5,000, 8225. So this distance here in terms of money is 8225. There's only a 5% chance that your wealth will lose more than 8225, and the value at risk to the 95% level, there's obviously a risk you'd lose everything or a lot more here, is 8225, and this means that there's only a 5% chance that after the day you will have lost more than 8225, or we're saying that the 80,000 could fall by 8225. So 80,000 to get away is 71. There's only a 5% chance that the value of the portfolio will be less than 71,775. Only a 5% chance that you'll lose more than 5225. And this is the value at risk. Okay, this is what you're standing to lose to only a 5, more than that, only to a 5% chance. If we're asked to do this, not to just a 95%, but to a 99% level here, then what you do is you go down, and we want just 1% in here, so we're looking at a 99%, either 0.5 or a 50% there, or a 45% there, and a 1% in there. Of course, 1% 0.01. So we want only a 0.01% chance, or the 0.45 there. So what we need to do is we want the 0.45 area here. So in this one here, we go back to the tables, we're looking for 0.45. So a big one, wrong. 0.49, 49%, beg your pardon, 49%. So 50, 49 and 1% is the way it's going to be split. So we need to look back here at as close as you can get to 0.49, representing 49%. So we're about in here. That's very close to it. 0.4901. So it's 2.33. So the Z value, which splits up the population, or splits up your values here, 2.33. So how much is this in terms of the actual loss you might make? It's going to be 2.33 times the standard deviation which we're dealing with. I think it said the standard deviation was 5,000. $11,650. So what this means, there's only a 1% chance that you lose more than 11,650 in a day. Assuming the standard deviation, of course, is for the variations within a day. So this 1%, this 5% are called confidence levels, how sure you are, how certain you are that you won't lose any more than the value at risk. And this 11,650 is the value at risk really to the 99% level of certainty. One more thing to do on it, and that is looking at how do you convert value at risk for, let's say, a day to value at risk maybe for 5 days, 10 days, 30 days. If you hang on to your investment for 30 days, and of course it's wiggling up and down all over the 30 days, where is it likely to be, let's say, after 30 days here? And this is where you just have to learn something, really. We've got it written up there in one way, but I would say that the sigma for the period is going to be the sigma for the day times the square root of the period. So if you're doing 30 days here, so what we had was a sigma for one day. An example we were doing was $5,000. And let's say we're looking for 30 days, what's going to happen roughly at the end of the month? Then the sigma for the 30 days is going to be 5,000 root 30. Or if it was 5 days, it'd be 5,000 root of 5, square root of 5. Or it was 100 days, it'd be 5,000 times the square root of 100. So this, in this case, let's work that out here. It's going to be 30 square root is about 5.4 times 5,000. It's going to be 27386. Of course, it's going to be greater than for one day because you could have a run of bad luck. You lose 5,000, lose 5,000, lose, you know what I mean? But the chances are it's going to jiggle up and down a little bit. But nevertheless, there's quite a wide dispersion of the risk there. So let's then go back and say what we're going to be interested in here is we're going to hang on to our investment. Our investment, I think, was at 80,000 mean. But we're going to be looking at what happens after 30 days. And we know the sigma for 30 days is 27,386. And let's go back and do it to the 5% chance. So it's going to be 0.45 or 45%, 0.5 or half, or 0.05 in there. Okay. We know that the Z for, if you like, the 0.45. And again, you can look at it. You look in the middle of the tables. For 0.45, you get onto these as 1.645. So we know that this is, in terms of standard deviation, 1.645 sigmas. But now we translate that into real money. And here the standard deviation is 27,386. So what we're looking at here is 1.645, this distance in absolute terms, not just in terms of standard deviations, 1.645 times 27,386. So 27,386 times 1.645, it's about 45,050. This is your value at risk to the 95% confidence level for 30 days. What that means, if you hold your investment for 30 days, it's jiggling up and down, there's only a 5% chance that you will lose more, or its value will be less than, you lose more than 45,050 over the 30 days. This is quite important. It's a nice, relatively simple, multiple choice type question to set. The biggest trick probably is this one here, remembering how to convert a daily rate into a period rate, or sometimes going the other way. So it is covered well in the notes, so do have a little practice at that. Sensitivity analysis is the next one. Sensitivity analysis is looking at varying some of our assumptions to see how far they can vary or change before we break even, or before we go from a positive NPV to a negative NPV. The problems with the method is you can only change one variable at a time. and it says nothing about the chance of a particular variable changing so much that you're going to get into trouble. May require some decision rules about where the sensitivity is so great that you prefer not to invest in this as well. But it gives you some quite good indications of where you might like to spend time and effort trying to find out more about your estimates about a particularly sensitive topic. So let's look at this here, where a lot of the work's been done to us. We're looking at a discounted cash flow calculation. I'll just kind of talk you through it here. So here we have the cost at time 0, and of course the discount rate is 10%, but the discount factor is 1. With sales, we're assuming that there's a volume of sales of 1,000, selling at a selling price of 100. And here there's 3.17 here. This is the 1 to 4 10% factor. You can get that from the tables which are provided. So the present value of these 4 flows discounted at 10%, 317,000. Similarly, the costs here, 1,000 units, the cost is only 60, so coming out at 190,000. Then we have a bit of scrap at the end, coming in 17,075, and we have a net present value here of 13,875 positive. So the conventional wisdom would say go for that. But if you think about it, this 13,875 is really rather marginal when you look at these very large figures in here. Then you have to change maybe a little bit before this positive net present value becomes 0 and indeed negative. And what we're always trying to do here is to get this down to 0. Okay, how far can we change an assumption before we get the NPV down to 0? Because when we get down to 0, we're going to be then a little bit more going to be changing our minds. So we'll do this with a couple of things here. Let's look at the initial cost. I think you can easily see that if this cost rose by 13,875, then this would be 0. Be an extra negative 13,875 there. This has simply come to 0. And the sensitivity to cost, all of these sensitivities are nearly always done with respect to a percentage, proportional change. The 13,875 divided by the 130,000 times 100, so 13875 divided by 130,000, it's about 10%, 10.7%. So if your costs went up about 10-11%, you're beginning to change your mind. Would we worry about that? Well, maybe not, because actually of all of these figures on this discounted cash flow, it's probably cost which is the easiest one to actually assess. You can kind of sign a contract now. We're going to be spending money pretty soon. There are probably fewer unknowns in that than anywhere else. Let's look at the selling price, this 100. I think you can probably see if that 100 was to go down by 1%, then this will go down by 1%. There's a very direct relationship between this, because this is 1,000 times 100 times 3.17. You put that down to 99, you're taking 1% off that. If this figure here was to fall by 13,875, then again you'd be 0. So the sensitivity to the selling price is 13,875 divided by this figure here, 317,000. So you look at it as a percentage of what you're actually changing in that column. So how far could this 317,000 kind of fall there? Well, it's 13,875 divided by 317,000. It's about 4.4%. Now, I would suggest that people get quite worried about that. Just reducing a selling price by kind of 4 or 5%, something is pretty common maybe in terms of sales and so on. Selling price that the product will actually shift at is going to be quite hard maybe to assess and so on. There might be competitor pressure coming in, which makes you have to reduce your selling price and so on. So I would say, this here is kind of quite a difficult figure to be dealing with here. I think it would be quite nice here if we get some more information about that, to really see what are the chances of having to drop your selling price by more than 4.4%. The final one I'll do is contribution. I beg pardon, volume, not contribution, volume. So you look up here and you say, well, which of these figures is going to actually be affected if I change the volume? And both of these will be. Effectively, if you change the volume, you change the contribution. So if you were to reduce the volume by 50%, that would go down 50%, and that would go down 50%. So the contribution we've got in here so 317,000 126,800. And if the contribution were to fall by 13,875, again we'd be in some trouble. So the percentage fall that we could tolerate here is 13,875 over 126,800. So 13,875 divided by 126,000 is about 11%. So we can stomach a much higher reduction in volume, much higher percentage in volume, because of course when you take something of the selling price, it's pure loss. When you reduce the volume, you lose the revenue, but you also save some costs, so you'd expect that not to be quite as sensitive. So you can do that for lots of things. It's all kind of covered in the notes and so on here, to work out how sensitive your decisions are to some of the assumptions that you're actually making. The risk-adjusted discount rate, something we'll cover in greater detail later. It's only in here for completion, really, completeness. What it is saying is different projects have different risks. And if you're embarking on a risky project, maybe what you could do is to increase the discount rate that you're using. So an ordinary project, maybe you discount at 12%. A risky project, you maybe discount at 20%. The great thing about this is that with discounted cash flow, the further off the cash flow is, the more heavily it is discounted. So if you increase your discount rate from 12% to 20%, you're really eating into this future value of the money really very deeply indeed, which is just great. Because of course it's the flows in 5, 6, 7, 8 years time which are most at risk, which are most difficult to actually assess. So this is done by increasing the discount rate for riskier projects. And we'll see later how there may be mechanisms for discovering what discount rate to actually apply to riskier projects. Next we have certainty equivalent, which is where you convert your future flows into what's called a certainty equivalent here. So let's say we had a very simple little project. At time 0 we had 10,000 going out. Let's say time 1 we had 4,000 coming in. Time 2 maybe 3,000 coming in. Time 3 maybe let's go another 3,000. Time 4, so it's only 10, let's say 2,000. And maybe let's go put another one, 5. So what it recognizes is that the these future flows, they're uncertain basically. The up front one is probably certain, but we're not very sure what the year one is going to be. We think it's going to be 4,000, but maybe to account for the little bit of uncertainty in there, maybe we multiply it by 80%. We're really saying that the chance of getting 4,000 in year one is equivalent to the certainty of getting 3,200 in year one. Then maybe year two is a little bit further off. Maybe we're going to say that's 0.75. So 3,000 times 0.75, 2250. And maybe this would be like 50%. And then we're getting really far away here. We might discount it very heavily indeed here, maybe down to 25%. And this one's here hardly worth anything because it's so far away. So all of these figures have been reduced to what's called a certainty equivalent. And then what you do is you discount and what's called the risk-free rate. In other words, what we've done is we've taken the risk into account in this step here. These are certain figures as far as we know, and we discount at what's called the risk-free rate. The big difficulty is that the 0.8, the 0.75, the 0.5, the 25%, the 0.0 are completely arbitrary. There is no mechanism, no rules, regulations for deciding how far you should be discounting these future flows to account for the uncertainty. Regression analysis aims to predict certain things. So the x in here could be the volume you're making, and the y could be the cost. So we're doing a cash flow kind of calculation. We're worried about maybe the risks associated with understating or overstating the cash flows. We want to be able to predict what costs are going to come out if we are producing a certain volume. And we use regression analysis. This purports to connect two variables, volume and cost, for example, or maybe volume sold and selling price. We just need to be certain care in this here. If you've got very few values, you've got very little evidence, there's really any connection at all between the two variables. It could be a very poor fit. What the linear regression does here is you could have two kind of variables where the points are all over the place, but linear regression will determinantly give you the best straight line it can through them. But obviously if you've got lots of stuff out here that's kind of not accounted for very well, how much reliability can you put on believing what this line is saying? That's why you have to use what's called a coefficient of correlation to try to test how good the fit is. You need care with what's called extrapolation. So here we have our maximum, let's say it is volume, let's say it is cost up here, and somebody says, well, next year we think we're going to be making this out here. Linear regression would say that you want to extrapolate in a straight line. You have no evidence of actually what happens out here. Your costs could really begin to rocket up here because of overtime costs or machinery getting inefficient. This is working hard. So extrapolation is very dangerous. You're going to a kind of unexplored territory. And finally, it doesn't prove cause and effect. Let's say instead of cost and volume, what we had was the volume being sold here, and in here we'll put the advertising expenditure. And we see this very nice line going up like this, and the advertising manager says, look, the more I spend on advertising here, the greater the volume being sold. In fact, they might be quite unrelated. The ads might be awful, and all that's happening here is maybe the economy is improving. So as the economy is improving, the volume being sold will probably increase anyway, and almost coincidentally, as maybe the profits of the company are improving as the economy improves and we spend more on advertising. So we get this what's called a spurious correlation going on. Finally, we have what's called simulation, where you try to mimic what might actually happen in practice. And the commonest one or approach is Monte Carlo simulation, where you use random numbers, hence the gambling or the almost roulette wheel type of idea. You use random numbers to generate a kind of typical pattern, maybe of sales or people queuing or breakdowns and so on. So let's say that we know that on any particular day, 0.3 of all days, 3 out of 10 days, 30 out of 100, sales are high and the other sales are low. Now we know it's going to kind of average out, but you could of course get a bad run. You could have low day, low day, low day, low day, low day, because the probability is reasonably high there. What's actually going to happen on our cash flow if we get this run of bad luck, and how likely is it to actually occur? It'd be quite nice to almost model or mimic, how this kind of sales go up and down each day. So what you do is you take these probabilities, and we're going to be using here 2-digit random numbers, and in here 00 to 29 you have 30, okay, and in the other ones here 30 to 99 you have 70. So our numbers 00 to 99 mimic or represent or are equivalent to your 30% of high sales days and your 70% of low sales days. And then what you do, ideally by computer, is you generate a whole list of random numbers. So let's say the random numbers come up, and I'm just trying to make this up without thinking about it. Let's say it's going to be kind of 49, let's say kind of 15, let's say 7, let's say 89, let's say 91, let's say 63, let's say 42, let's say 21, and so on. I'm just trying to do this. So you say 49, well that falls into your 30 to 99, that's going to be a high days, a big one. It's going to be a low one. 15 falls into this range here, so the next day we're getting high sales, and again a high. 89 comes into here, this means it's going to be low sales. I think it's going to be low sales, then low sales. Well gosh, we're getting a big run now of these low sales, and eventually we get a high sales. You can kind of put this into your cash flow. Low sales, high sales, high sales, low sales, low sales, low sales, low sales, high sales, and see your actual bank account kind of going up and down, as it typically could, in much more detail than saying, on average, sales are going to be some sort of expected value of your 0.3 and your 0.7.